Hey guys, how's it going? Welcome back. In today's video we're going to be looking at the final part of topic 6. In the topic we're going to be focusing on ethical considerations and sustainability of the financial services sector. As part of the video, we're going to be focusing on the importance of ethics, key ethical considerations that financial services may have to or choose to take into account. We're going to be looking at CSR as well as the risk of systemic failure. So, how important is ethics in the financial sector? Well, when people save money, they place it into the care of a financial services provider, such as a bank. They do this as they believe it a safe place to be. They also hope it will earn a return. Ethics are of particular importance in the financial sector because depositing money anywhere relies on trust. If consumers do not have this trust, they will not entrust their hard-earned money to the provider. So some of the key ethical considerations that financial services providers may have to or may choose to take into account are as follows. Firstly, they may choose or have to take into account unfair pay to their workers, unfair pay to their suppliers, poor working conditions for their employees, environmental issues such as avoiding pollution, product sustainability, ensuring customers understand the terms and conditions of certain financial products, political issues, i.e. doing business with governments that are widely perceived as unethical, or making ethical investments. Investments which are seen as ethical might be avoiding those which test on animals, might be avoiding those which produce arms, and also avoiding investing in companies that produce morally dubious products. So, how do they show that they are investing sustainably? Well, they may choose to become members of the UK Sustainable Investment and Finance Association. The UK Sustainable Investment and Finance Association is a membership organisation for those in the finance industry committed to growing sustainable and responsible finance in the UK. It defines sustainable investment and finance as sustainable finance relates to investment and finance that considers environmental, social and governance impacts. You might see the shortened abbreviation as ESG. What might a financial provider's decision whether or not to be ethical depend on then? Well, it might potentially boil down to whether being ethical might generate them a greater amount of profits or not. Many providers have shareholders to please and therefore their main objective is to earn profits. If by taking into account ethics when making decisions they are to increase the amount of profits they make, then this might be a reason why they want to be ethical. Corporate social responsibility, or CSR for short, relates to ethics. It's a form of self-regulation now practiced by many large companies. It is a way in which a company can demonstrate that there is a social conscience behind its business model. It involves setting procedures and standards that are ethical and comply with how society expects it to behave before regulations and laws force it to change to behave in a certain way. A company with an active CSR policy is showing that it is trying to take responsibility for its actions and have a positive impact upon the environment, upon its consumers, upon its employees, communities, and upon other stakeholders. So, when we're talking about corporate social responsibility, we want to have a positive effect on all of these 7 different stakeholders. That said, however, even firms with a clear CSR policy can be guilty of mistreating certain stakeholders. When it comes to customers, for example, there was the big scandal a number of years ago about mis-selling PPI. So we have to question sometimes what is the true value of having a CSR policy when these scandals still take place. In terms of sustainability in the financial services sector, financial services sustainability has several aspects to it. It might be the sustainability of financial services providers, ensuring that they do not go bust, do not go into liquidation or go bankrupt. The Financial Conduct Authority and the Prudential Regulation Authority ensure that providers keep enough assets, for example, on hand in order so that their risk of going bankrupt is significantly reduced. We also consider the sustainability of the personal finances of individuals. Now, there are a number of things that providers can actually do to enhance and increase the likelihood that personal finances of individuals remain sustainable. They might wish to encourage individuals to open savings accounts, to encourage them to have a contingency or rainy day fund. They might also warn them if they are likely to go into their overdraft or miss a repayment on a mortgage or loan. The third part of sustainability when it comes to financial services is the sustainability of the financial system and avoiding systemic failure. What is systemic failure then? Well, financial service providers such as banks work very closely with each other. They trade in financial markets by borrowing from and lending to each other, and by buying and selling financial securities from and to each other. Financial markets now form very complex networks that exist on a global scale. The fact that banks are involved in such complex networks means they are interdependent. Interdependence is a weakness because it exposes the members of a network to systemic risk. If one major financial provider in the system were to fail, the other financial providers would be adversely affected, and the whole system may be at risk of failing. Essentially, because some lenders borrow from each other and some lenders lend to each other, if one particular lender went bust or one particular borrower went bust, a lender would not be able to get their money back. Thus, they would lose a significant proportion of their finance, and this would potentially have to be passed on to consumers, or the bank might go bust themselves. The ability of financial markets to keep going, therefore, is based on confidence. If confidence is undermined, the system fails. A financial system that operates with a realistic chance that it might fail is therefore not sustainable. So what could the impact of systemic failure be on personal financial sustainability? Well, if systemic failure took place, people may not have the ability anymore to make payments. There would also be an effect on savers, in particular if their specific financial provider went into liquidation, they may not have the opportunity to get their savings back. That said, in this country we do have the FSCS, the Financial Services Compensation Scheme, which means that deposits up to £85,000 are guaranteed to be returned to that individual. There would also be a significant impact upon the stock market. If there's less confidence in the banking system, then the stock market is likely to take a significant hit. That means, of course, that individuals who have invested heavily in the stock market might lose a significant proportion of their investment. There will also be a lower level of investment made, as well as the confidence in the banking system reducing to a very low level, thereby reducing the amount of people potentially depositing in savings accounts. So, now that we've looked at the fourth part of topic 6, let's check our knowledge. But before we do so, make sure you hit that like button and smash that subscribe button to be notified when future videos are released. Once the case studies are released, I'll be recording case study review videos. I'll also be recording model answer videos, so make sure you hit notifications to be notified when these videos are released. So, question 1. Which of the following is an example of a movement that is based on a consideration of the producers in developing countries? Is it A. Consumer welfare, B. Ethical investments, C. fair trade, or D, green consumer? The answer to question 1 is C. Fair trade is an example of a movement that is based on a consideration of the producers in developing countries. Question number 2. Which of the following terms describes how a firm can demonstrate that there is a social conscience behind its business model? Is it A, community social responsibility, B, company social regulation, C, consumer social requirement, or D, corporate social responsibility? The answer to question 2, of course, is D. Corporate social responsibility describes how a firm can demonstrate that there is a social conscience behind its business model.